Hey, folks, welcome to InTheMoneyStocks.com's live trading action video. My name is Gareth Soloway, Chief Market Strategist here. Today's date is Monday, June 24th, 2019. So I have to talk a little bit about the divergence developing here between the Russell, the IWM, and the S&P 500. So the S&P, basically the last three trading days, neutral sideways action. I think Friday we were down a little bit. The S&P is basically flat today. But if you look at the Russell, the IWM here, the Russell has collapsed. I mean, we're seeing the Russell down 0.8% today. On Friday, it was down more than that, almost 1%. And that's all while the S&P's essentially gone sideways. Now, what's such a mind-boggling facet here is that in a low-rate environment, the small caps should be doing amazingly well. They should be outperforming everything. But look at this. If I zoom out on this chart, so if we quickly go to the S&P, right? So if we bring up the S&P, all right, S&P basically at all-time highs up here, right? You can see a little bit of resistance up here, but nonetheless, it's right there. It's right there, flat on the day today, down 4 cents. If you go to the Russell, look at this, folks. I mean, when you're zoomed in, it looks like we're close to the highs, but then you zoom out, and you're like, holy cow, the Russell was all the way up here. We haven't even gotten close to those highs. So that's something that really should be noted here. And again, I'm not really sure what to make of it other than it makes me very kind of nervous out there. I also think the fact that the market is loving horrible economic news is definitely something that's not a long-term solution. Like, think about that. The market cheers when we get horrible economic news. So when it looks like the economy is crashing down, the market goes up. Well, why? Why does it do that? Well, because it thinks that the Federal Reserve will come in and save the day with even more rate cuts. Problem is, the Fed only has a little bit to go till they get back to zero. I mean, there's not a whole lot that they can do. It's not like they're starting, when we had the Great Recession in 2008 and 2009, interest rates were above 5%, so you had a long way to go. They're basically around, I mean, right now, the 10 years underneath 2% right now. There's not a whole long distance to go to get down, so there's not a whole lot of bullets left in the gun for the Federal Reserve. Could they do more quantitative easing? Sure. But then gold's just going to keep going up. Bitcoin's going to keep going up, which I've been championing Bitcoin and cryptocurrencies now for the last almost year. I mean, I absolutely have loved them. I just over the weekend, I sold my Bitcoin and my Ether, my last halves of my Bitcoin and Ether, because I just think the run's a little too much right now. But on every pullback, I'm buying again, folks. I mean, I love it that much. I love cryptocurrencies. The more the governments talk easy money, the more the debts mount, the more that the Federal Reserves want to print money and stimulate, the more cryptocurrencies and gold make sense. All right, you got to diversify out of fiat currencies a little bit at least. I mean, if you're not doing that, you're crazy in my opinion, because your dollars are getting diluted, your yen, your euro are all getting diluted as these governments and these central banks print more money. It's nutty. But anyways, bottom line is, going back to this, folks, this should be kind of a red alert to everyone. The Russell, again, down sizably the last few days. I mean, think about the market on Friday. It was basically flat today on the S&P flat, yet the Russell has dropped almost 2% in the last trading days. 2% is a big move for the market, for the Russell. So that has to be monitored. A couple things else I like. I'm short shop right now, and I want to show you the topping tail this had. This had a beautiful topping tail. Look at this. Topping tail last Thursday, a little down Friday, and look at the sell-off today. This is the trend line you're watching if you're following shop or if you're short shop. It's going to have support at this trend line. If it gets below and confirms, it's got downside all the way down here, folks. You have a gap fill basically at 275, which is where that target would be. That's if it breaks. It has to break and confirm below this line. Right now, we're just kind of teasing that line at this point. But if it gets below that, trouble for SHOP. Okay, so that's that, folks. Other than that, I don't see a whole lot else out there. Markets, again, very, very quiet today. The spiders, if we go to the spiders, still down to basically 5 cents on the day. The volume today, as it's about 15 minutes to 2:30, a quarter after 2 right now. 23 million is insanely thin volume. What does that mean? It means that everyone's just waiting on the G20. Now, let me just quickly talk about the G20, because that's a kicker too. That's a mind-blowing kind of mind screw right there. Because if you ask me, first of all, the average investor is like, oh, if talks can start up between China and the U.S. again, that'll be great for the stock market. I actually think it's the opposite. I think the markets will sell off if talks resume. Now, you might say, well, why on earth would they sell off? Because that would be a good news, right? Well, the problem is, if talks resume, it means there could be a likely trade deal. If there's a likely trade deal, the Fed's definitely not going to cut rates. I mean, think about that. If the Fed, I mean, think about you get if the Fed cuts rates, right? And then the next day, let's just, I mean, just for arbitrary purposes, we'll just say the next day or the next week, you get a trade deal, which is going to take away a bunch of these tariffs. It's going to stimulate. It's going to help help companies. It's going to help hiring. It's going to lower costs. It's majorly stimulative for the economy, the global economy too. So the Fed's not going to cut rates, and then all of a sudden, that would talk about egg on their face. So the only way they're going to cut rates, which is why the market's rallied up recently. I mean, this whole rally from down here up has been because the market has been pricing in aggressive rate cuts coming starting in July from the Federal Reserve. The market's even talking 50 basis points now for July. And the only way that's going to happen is if there's no chance of a trade deal. Otherwise, the Fed's not going to do it. All right, so it's just really interesting times. I mean, you think about it, the market itself is almost rooting for the economy to do poorly. Now, very counterintuitive, because in general, what that's going to mean is that if the economy weakens, then earnings for companies are going to drop. The PE ratio for the S&P is going to expand. If the markets are going up while that's happening, then the PE is going to expand even more. That's not a good thing. A low PE is value. If you get a too high PE, it means it's a bubble. And again, this is one of the weird times in the markets where this stuff is going on, where these shenanigans are being played by the Federal Reserve. And the Federal Reserve has been the culprit for every bubble bust cycle that we've had recently in the last. I mean, think about this. The Federal Reserve has become more and more scared of recessions because they become nastier and nastier. They become nastier and nastier because, guess what? The Fed has been intervening and pumping money to save the market when it goes into a recession. So I mean, it's kind of what comes first, the chicken or the egg? But ultimately, the Fed is the culprit. And, I said this to our members before, and I'll say it again, folks. The next collapse we have will make the Great Recession of 2008, 2009 look like child's play. It'll be that bad. And now the question is, will it happen? And I'm not going to pretend to know exactly when it's going to happen. I do think in the next 10 years, likely, probably in the next 5, it will start. But it will be like nothing we've ever seen before, folks. I mean, it'll be like Great Depression-ish type stuff. And again, I hate to say that because I don't wish that on my worst enemy, a period of that, but it probably will be. And that's sad. And again, I almost will tell you that the Federal Reserve in its form will not exist after that period. And it doesn't take a genius to know that they're the ultimate culprit of it, because anytime you pump, I mean, basically the QE and cutting rates it's a drug, right? It's a needle with drugs in it. You're injecting it into the market. The market gets high, it gets happy, it starts to need that stimulus. And what happens? You need more and more drugs to maintain your high. So it's more and more and more and more and more to just get the same high. What does that mean? Well, when you crash, when you go off of the stuff, the withdrawal symptoms are even worse. The analogy is fantastic. I mean, it's a perfect analogy. So in any case, I'm going to leave you with that. Bottom line is, folks, what I tell our members here is that we're going to make so much money during that period, up or down. As long as there's volatility, we make more money. So on a quiet day like today, we only had one day trade in the chat room, made a little bit of money. You give me volatility, you give me a period of craziness, and we're going to clean up. But I still don't want to see that for the rest of the country or the world. I mean, we just don't want to see that type of environment. But we will make money here. I encourage you to get here and join, learn the PPT methodologies, because it will save your butt. While you're, unfortunately, the rest of the world is suffering, we'll do all right, which is good, because then we can maybe help those less fortunate. We'll have that ability to help those less fortunate. Okay, on that note, I'm going to bid you farewell. Check out our track record. That speaks for itself. Countless wins this year and continuing to have profits. Have a great one. Take